This video will explain the reporting of cash, the basic principles of cash management, and briefly introduce a cash budget. Cash consists of coins, currency, checks, money orders, and money on hand or on deposit. Checks that are dated later than the current date, a post-dated check, are not included in cash. Companies report cash in two different statements, the balance sheet and the statement of cash flows. The balance sheet reports the amount of cash available at a given point in time. Because it is the most liquid asset owned by the company, cash is listed first in the current assets section of the balance sheet. Cash on hand, cash in banks, and petty cash are often combined and reported simply as cash. The statement of cash flows shows the sources and uses of cash during a period of time. When reporting cash, many companies use cash and cash equivalents. Cash equivalents are short-term, highly liquid investments that are both readily convertible to cash and so near their maturity that their market value is relatively insensitive to changes in the interest rate. Generally, only investments with maturities of 3 months or less qualify under this definition. Examples of cash equivalents are treasury bills and money market funds. Cash that is not available for general use, but rather is restricted for a special purpose, should be reported separately on the balance sheet as restricted cash. If the company expects to use the restricted cash within the next year, it reports the amount as a current asset. When this is not the case, it reports the restricted funds as a non-current asset. This is a partial balance sheet for Delta Airlines. The company is required to maintain restricted cash as collateral to support insurance obligations related to workers' compensation claims. Delta does not have access to these funds for general use, so it must report them separately as restricted cash. Many companies struggle not because they fail to generate sales, but because they cannot manage their cash. A company can improve its chances of having adequate cash by following 5 basic principles of cash management. First, increase the speed of collection on receivables. One common way to encourage customers to pay more quickly is to offer cash discounts for early payment. Companies can offer terms such as 210 net 30. Another principle is to keep inventory levels low, but not too low that you lose sales. Maintaining a large inventory ties up large amounts of cash as well as warehouse space. Delay payment of liabilities. Monitor when bills are due to avoid paying them too early. Carefully consider the timing of major expenditures. If possible, make them when the company normally has excess cash, which is typically during the off-season. And lastly, invest idle cash. An important part of the treasurer's job is to ensure that the company invests any excess cash, even if it's only overnight. Because cash is so vital to a company, planning the company's cash needs is a key business activity. The cash budget shows the anticipated cash flow, usually over a 1 or 2 year period. It contains 3 sections, the cash receipts, the cash disbursements, and financing sections, as well as a beginning and ending cash balance. Preparing a cash budget enables the company to plan ahead to cover possible cash shortfalls and to make investments of idle funds. We will discuss the basics of cash budgeting, and a more advanced discussion will occur in Accounting 2. The cash budget starts with the beginning balance. The cash receipts section includes expected receipts from cash sales and collection from customers on credit sales. This section also shows anticipated receipts of interest and dividends, as well as proceeds from the sale of investments, plant assets, and the company's capital stock. To arrive at total available cash, you simply add the beginning cash balance to total receipts. The cash disbursements section shows expected payments for inventory, labor, overhead, and selling and administrative expenses. It also includes projected payments for income taxes, dividends, investments, and plant assets. It is very important to note that a cash budget does not include depreciation, since depreciation expense does not use cash. Once you obtain the total disbursements, subtract that amount from total available cash to arrive at the cash balance before financing, or the excess or deficiency of available cash over disbursements. The financing section shows expected borrowings and repayments of borrowed funds plus interest. Financing is needed when there is a cash deficiency or when the cash balance is less than management's minimum required balance. This cash budget indicates that the company will need $3,000 of financing in the second quarter to maintain a minimum cash balance of $15,000. Since there is an excess of available cash over disbursements of $22,500 at the end of the third quarter, Hayes will repay the borrowing plus $100 of interest in Q3. The last thing I want to mention when it comes to the cash budget is that the ending balance of one period becomes the beginning balance for the next period. Companies often prepare cash balances on a monthly basis. To minimize detail, this budget was prepared by quarters. A cash budget contributes to more effective cash management because it can show when a company will need additional financing well before the actual need arises. It also indicates when the company will have excess cash available for investments or other purposes. The solution to this exercise will be provided in another document.